will the Fed raise interest rates in the December meeting? And that is what has dominated the media. It had taken a little bit of a break after we had had that big 1,400-point down day. And now we're back. The Fed has injected themselves. They've made December a quote-unquote live meeting. And you have a lot of media lemmings who are jumping on the bandwagon that the rate hike is on. I mean, it's like it's a done deal. I mean, it's like it was already done. I mean, what are we even talking about? It's a done deal. So I want to bring a little bit of, I would say, my take on this. So I'll first and foremost need to start this off with disclosing that I am a moderate Republican, and that may, I guess, influence some of what I'm about to say. But this is what has been going on, and I view this as fact. So we've had a very, very slow economy. This has actually been one of the weakest recoveries in industrialized history since the Depression. And we've had I would say, incompetent, maybe that's going too far, but we have had an incompetent president. He has done very little in terms of fiscal policy that will promote policies of growth. In fact, last week he struck down the Keystone Pipeline, which was an infrastructure job creating project, and has instead promoted climate change. That to me is amazing. So what this has done is it has crushed industries like coal. It has done an amazing amount of damage to the labor market, because companies don't have visibility in terms of what their profits are like, and they have a new tax known as Obamacare. So that backdrop has created that uncertainty, and the amounts of regulations that have been heaped onto entire industries like the financial service sector, for instance, has been obliterated with Dodd-Frank. And what's amazing about that is that nothing in Dodd-Frank would have prevented the 2008 and 2009 crash, which was the reckless lending, not their proprietary trading desks and such. So what that has done is that has forced the Federal Reserve to be the sort of single engine powering a 747, and that would be the U.S. economy. And we know that the Fed is very powerful, and to ignore the Fed is reckless. It's stupid and it's reckless, and we have seen the power of the Fed being able to take the market from in the 600s to over 2100. Very, very impressive move. I have said that I believe Ben Bernanke saved the world. I think that Janet Yellen she's not Bernanke, I'll tell you that. I don't believe her communication skills are as attuned as his, but I do believe she has been carrying on his policies. The problem we have here is if we lose the Fed, what do we have? We have a year more of Obama, and that's a year with campaigning, and you have everybody basically telling you why, from the Republican field, why things are terrible and who to blame for it. And the Democrats, you have them moving as far left as possible with Hillary Clinton trying to match Bernie Sanders. And you get what happened in biotech a few weeks ago, where she came out basically and said drug prices are are too high, and biotech got slammed. So it's sort of like a rotating gong show. And we'll talk about that when it comes to some of these stocks and their earnings and their reactions post-earnings. So that is the backdrop that we are in right now. So what this has led to is, we know, multiple rounds of quantitative easing. And you've had a pretty large inflation of stock asset prices. You've also had that fueled by corporate buybacks, because they are borrowing cheaply. I wrote an article about this, about how Apple is sort of gaming the Fed, that they're borrowing at sub-governmental borrowing rates, and they're buying back stock or paying dividends. They've also forced Sorry, I've been a little bit under the weather for the last few weeks. I think I put on a good face, but I haven't been feeling that well. I'm sorry. Anyhow, sorry if my voice sounds like Kathleen Turner. Anyway, so they have done that has fueled a lot of the equity rally. In addition, you've had not paying interest on, I guess, savings account. If you ever go into the bank, it's a joke. You know, they call me all the time, usually around this time of year, so I'll probably get a call soon asking me to put more money into my bank account, and I always tell them, why am I going to bother? I'm basically paying you to keep my money. So that has forced a lot of people into the stock market who would normally not be, and they have been the ones in these sort of bond equivalent stocks. I had talked about, you know, J&J and these types of stocks trading at their peaks like 30 times earnings just to chase a 3% dividend. And a lot of that money had been piled into oil, and those stocks have come down tremendously as the asset has come down. And you've also had people who are not used to being in those types of assets selling. So where does that leave us here with the Fed? Sorry for that little sidebar. That leaves us with a few problems. One is that even with this strong jobs report, which really wasn't very strong, it's funny, the report prior to this one, which was a miss, the media came out immediately and said it was strong enough to be with rate hikes. It was like 137,000, and it had missed so big, so bad, it was absolutely incredible. And now we have a bit of a beat, and it's sort of not being explained why we have that beat. A lot of it is temporary workers that are seasonally employed. I also believe that corporations, to get around Obamacare mandates, which are really going to start hitting in 2016, are hiring people temporarily or with reduced work weeks to avoid having to pay the Obamacare tax. So I think that's kind of going to be the new normal. I'm sorry to say it, but I do believe that is the case. We have, as a result of this, the world has been very slow as well. I believe that a lot of the weakness that is now hitting in Asia and it has hit in Europe has been because of up until recently, stubbornly high energy prices. They don't have the reserves like we do with the shales. They don't have the horizontal drilling and hydraulic fracturing, and we have benefited tremendously from that. However, the cure for higher prices were higher prices, and an amazing increase of supply, and that price has plummeted. What has also hurt that pricing is a strong dollar. We have a very, very strong dollar. Europe and Asia got smart, and they realized that QE worked here for the most part, at least with regard to asset prices, and it sort of was the sole engine of growth, and they did likewise. So if we were just to be standing still without the Fed raising interest rates, the dollar would appreciate, and it has, because these countries have been racing to devalue their currency. If the Fed were to hike now, that would be the equivalent of pouring lighter fluid on a barbecue with regard to the dollar, and it would skyrocket the dollar tremendously. The problem then comes is that U.S. corporations that do business overseas have to repatriate those dollars, and they get less profit for it. And that has been what's been weighing on many companies. Even Facebook has mentioned that on multiple quarters, except for this one. That has been one of their chief reasons why their stock has usually gotten smashed after earnings. You're seeing this play out in a lot of stocks. So the strong dollar, it is hugely deleterious to earnings. It also makes buying U.S.-made goods like Caterpillar or John Deere, any of these big durable type of goods, or even smaller goods, less competitive. As we know, everyone always talks that we have a trade gap, particularly Donald Trump, that we run deficits, and a stronger dollar will widen that trade gap even bigger. It would be moronic, in my opinion, to want to do that willingly. With regard to commodities, the strong dollar, we have seen oil crash, we have seen you name it, soybeans, corn, Natural gas has been in a huge downturn, and the big scary one is copper. That is also commonly referred to as Dr. Copper. That is breaking down, and that signals recession. So we know we have a slowdown in addition to slow growth. So that could be a huge risk that if there's any type of a shock on a 2% growth economy like we have, whether it comes from Asia, it could be terrorism, God forbid, knock on wood, hopefully not like another 9/11 type of an event, or just even a weaker consumer. We all saw what happened with like Macy's today, for example. That was the gong show played out today in retail. More recently, we've had Walmart getting slammed. Yes, a lot of this is the Amazon effect, and a lot of people have been chasing into Amazon, as we know, and I do believe that they are stealing market share, but I think a lot of it has to do with weaker consumers. And if the consumer is weakening, that doesn't bode well for future earnings. We could have that slowdown, and if you're raising interest rates, which have a drag on growth effect, you could bring the growth rate back to negative. And as we all know, if you have 2 back-to-back quarters of negative growth, then you have a recession. That is the textbook definition. That's not an opinion, that is a fact. So my theory is that if I were the Fed, I'm not, of course, I would wait until we see what happens after the first quarter, which would be the March meeting. They have a meeting, they have a press conference, so they can explain it well. I believe we've had 2 years back-to-back with exceptionally weak first quarters. That doesn't mean that this one will be the same, but if I were the Fed, coming with 2% growth and not reaching, they've also, by the way, said that they wanted to mandate reaching a 2% inflation target. They're not even close to that with what's going on with commodities. Look what's happened. I mean, you would have to have such a huge bounce in these things to even get close to that 2% inflation target. It wouldn't even be funny, and we have the exact opposite. A lot of these people on TV like to bloviate, and they're always so afraid of inflation. What are we going to do about inflation? This is theoretical inflation. There is no inflation here. Commodities are crashing. We know this. So the real problem becomes deflation, because that becomes a vicious cycle. And that is what we have right now. We have deflation. It is huge. So my theory would be for them to see, first of all, how the holiday season goes, and then just take a look at the first quarter. They have been at zero for 7 years. Why is there some kind of a alarm bell, a rush to have to do it at the end of 2015? It's stupid. The Fed, I think, looks very smart right here, and I think that the fact that they are on hold is the right decision. Now, it has been posed to me many times, and it is mentioned ad infinitum on the television about it's only a quarter of a point, it's no big deal, it's symbolic. I've heard that said. The Fed has to regain their authority. This is nonsense. The fact that the Fed is moving is what is key, not the amount of the rate hike, although if they did too much, that could be a problem as well. But it is the fact that the market will pull forward future discounting. They will future discount more hikes to come. Now, I believe that the fact that the Fed would be moving shifts the policy from accommodation to tightening. And that is the key. You've had the Fed the Fed Bernanke put, the Yellen put for a long time, and they are, believe it or not, they have not even ended QE. Everyone says that they're not doing, they're not buying anymore. That isn't true. They're doing what I like to refer to as QE light, where they're still reinvesting runoff. So if something expires, they'll rebuy it, they'll re-up, they're re-upping. So they're still keeping the I guess they're not raising the level of the water in the pool, but they're keeping it steady. What I would do if I were the Fed, like I said, I would want to wait and see how the holiday sales go. I'd want to see, as we know, the retailers are not doing well. It's been a little bit warmer. That could have a huge impact on fourth quarter growth. We want to, obviously, the Fed, maybe they don't want to be the Grinch that stole Christmas, the Fed Grinch that stole Christmas. And I believe that if they are going to make a move, if they want to show they have a little hand, they want to do something, let's do the next incremental step. They stopped the more QE, so to speak. Why don't they just first stop the reinvestment? That would be the next logical step and a step in progression, as opposed to, playing hopscotch and jumping over that to the rate hike. So I would think that the correct procedure, even if we're just talking procedurally, would be to first stop the reinvestment before they went to the rate hike. That would look really smart, in my opinion. I would actually be on board with that. I think that would be okay. I don't necessarily know that we are. What would be good about that is that they would really, at that point, fully neutralize their policy. And if there is a shock, they can go back into the QE mode and save face, because all they did was go to neutral. If the Fed puts the car in reverse, so to speak, they are going to look very foolish having to backtrack on that after just a little bit, one decent data set. I think the Fed needs to see multiple data sets personally, but I guess that doesn't make for ratings. But they would have to backtrack. They would look very foolish. They'd lose a lot of credibility. I mean, let's just face it. The Fed's growth targets, they haven't met any of them. They haven't met their inflation targets. What's even more of a joke is if you look at the bailout packages for Greece from the World Bank, the projections of growth, I mean, if you missed this badly on Wall Street, if you were one of their, if you were running money or if you were an economist, you would be fired so fast it wouldn't even be, you'd be like escorted out of the building from like security, like Bill Murray did to Bobcat Goldthwait in Scrooged. That would be, you'd be looking at your watch on how fast they hit the curb, and that's really it's really kind of an embarrassment. They've been overly optimistic. They've been wrong. The only thing they've done right is not doing anything with policy, or they've been doing more QE. They've been very reactive. So that's my opinion with regard to that. I mean. You can't. I talked about shock risk. We had that with the Japanese earthquake, which triggered a nearly 20%. I think it was like 18 and change percent correction in the S&P. That could happen again if we are, particularly in a tightening policy. That's also a huge risk. To get more domestic, I know a lot of people get really upset when we talk about more macro, but we have a huge amount of debt. We have $19 trillion in debt. You raise interest rates, that raises the amount of we spend on debt service as a percentage to GDP. You start hiking that up. It's a self-inflicted wound, and soon enough you're Greece. So what will this mean to the stock market? If the Fed doesn't move and the Fed stays neutral or accommodative, the stock market deserves to trade at a premium multiple, because it would be trading at there are historically low interest rates, and the amount that you will be willing to pay for future earnings and cash flows is higher. If the Fed hikes rates, that means that PE multiples, meaning the amount of money you'd pay for future earnings of stock growth, is less. And if you have multiple contraction, where does that hit? That will take out the growth stocks. They will get themselves chopped, because the amount that people will be willing to pay for their future earnings is less, because their risk-free equivalents, or more people will put money into bonds, even if it's marginally. The game will then become how many times the Fed will raise. Janet Yellen had, so there was a Fed leak a few months ago. They said that they weren't going to go past about 3.5%, I believe it was. That was my target for them, and they weren't reaching that until 2018. Oddly, they don't anticipate reaching 2% their 2% inflation target until 2018. So what the heck are they doing talking about raising interest rates? if you turned off the TV and you heard someone is missing their targets, they pushed out their projections on how long it's going to take to get there, and we know that things aren't stable and really not that good, what would your thinking be? Your thinking would be, not only will they not be raising interest rates, but they should be doing more QE, more accommodation. If you're not expecting to reach a 2% inflation target until 2018, they should be jamming their foot on the gas, not pumping the brake. They should be narrowing the gap between here and the end target. And the only way to do that would be to accelerate their QE. All right, so I don't think that will happen so quickly. I believe what we would need to see, if it was an ideal scenario, would be we get through the balance of the year, we see how the first quarter goes. I don't believe, unless there is a shock or some type of an event that causes that we can't anticipate, a non-anticipatable, whatever the proper English is, it's been a long day, something that's not anticipated. I don't believe the Fed would go until they first see the first quarter data and probably into the summer. I don't think we could even really begin to talk about QE, unfortunately. QE4, I guess it would be, or maybe they'll just skip QE4 and go right to QE5. I mean, I don't know. Maybe it's QE3S or Infinity S if they want to get on the Apple cycle. I think that would be in the summer, so I don't think it's really something to talk about. But I really don't believe they're going to raise rates this year. I still am standing by my lower for longer thesis. If you'd like to read about that, I'll post a link for that. It'll be in the rebroadcast in the description, along with the other article I mentioned about Apple and their gaming the Fed, in the description below this video. By the way, if you ever come into this video late or want to watch it again or see anything from the beginning, just go to my YouTube channel, Justin Pulitzer Trades. This will be up there this evening. So let's keep going. All right, so I think we ate our veggies on the Fed. Are you guys all clear on this, or do I need to do more? Let me know. I just type in the screen. I can see what you write. Do you want to talk more Fed, or do we want to go into stocks? And this is this will be mob rule. Let's see. Okay, good. That's not really an answer. Stocks, very clear. Stock. All right, so let's go into stocks. All right, so we're done with the Fed. Okay, guys. Okay. All right, so we're done with the Fed. Let's go into stocks, and let's start with the S&P. Let's go into the S&P. That's really the market. A lot of people like to talk about the Dow, as we know, but the S&P is really the most important. So today, the price action. It's funny. The internals weren't that bad today. The breadth was just a little bit negative. I think in the on the NYSE it was like 1.88 to 1 negative, and on the NASDAQ it was only like 2.1 to 1 negative. But the market itself felt a lot heavier to me than I think it may have appeared at maybe at first blush. And the reason for that is the breadth of the market is really narrowing. It was Veterans Day, so the bond market was closed. So yes, liquidity was maybe a little bit less, but it just felt very heavy to me. Yesterday was a pretty nice reversal. The bulls, I called it the Mighty Mouse rally into the close. They were able to get the market back up, and they were able to close okay. Today felt a little different. You had the gap down. Really what you should have had today was some continuation, and you did not. You had some early weakness in stocks like Apple, and the retail sector we know got taken out to the woodshed. Actually, I had been talking about playing Macy's short. I played it with put ratios. I actually reversed it slightly today to play mildly long. We'll see how that goes. It broke 42. That's a little bit weird. I wouldn't say weird, but it's concerning. You know, when you have stocks like Disney and Macy's trading, like biotech stocks or like tech stocks, that's not healthy. That means the market has a lot of risk. The breadth has been narrowing, and if you're not basically long, I'm just going to go through my list here. If you're not long Amazon, if you're not long Facebook, if you're not long, well, Netflix used to be, but not so much now. Google, and let's say Microsoft, you're probably losing money, as crazy as that sounds. So it's a really narrow subsector of stocks that have been chased and chased and chased. If you let's talk about Amazon, for example. I've been pretty bullish on the stock, actually. I was talking about it reaching 660.64, which is the 61.8 Fibonacci extension. I had talked about it being bullish over 619.45, which was the gap high of day. This all turned out correctly. You know, it ran a lot. I mean, we're up almost, I think we're up over 100, almost $100 from the earnings day. At least from the, if you bought it on the earnings day, you're up almost 100, like $75. Morgan Stanley today came out. I believe they put an $800 price target on Amazon. Congratulations, Jeff Bezos, who is now the 4th richest man in the world. 5th, if you still go, I think, by Forbes. So here's the question you need to ask yourself. If you buy Amazon today, do you have good trade location? Meaning, do you have a good entry point if the stock were to, let's say, pull back? Or do you have the risk of buying the top? What would you say your answer to that is? My answer would be is that you probably have bought the top. I don't know if it's the tippy top. I still think that there could be, believe it or not, still a little bit more room to go in Amazon. I would have loved to have seen something like today happen, an upgrade and a big gap and go exhaustion type of a gap at the top of a range. The only problem for me was that we had about 3 days worth of consolidation below this, and then we got the gap and go. If we had been up every day and then this happened, I would be more sanguine saying that this was the dead top. So I right now would be more into the sell the rallies type of mode on Amazon. I assure you at some point, probably in the not so distant future, you know, we all know they're stealing market share. They've clubbed Walmart. They've clubbed Macy's. They've clubbed everybody. They're doing really well. We know, I mean, I use Amazon all the time, frankly. I mean, if I want to go shopping for something, I'm not going to go to 5 stores to try and find the best price. I just go on Amazon. I pull up my phone. I put it in. We all know this is all known stuff. Amazon will probably peak somewhere near that Cyber Monday or whatever, maybe even before then. Kind of like an Alibaba with Singles Day. We'll talk about that in a moment. So I would say if you're fortunate enough to still be long in Amazon, I would for sure at this point book some profits, and I would be looking to lighten up still on rallies. Take a look on Amazon. If you go into a weekly or daily chart, it starts getting it's getting really steep. I mean, it's starting to get really steep. It gapped, it ran on earnings. I mean, obviously still bullish. You probably can still play some buy the dips in it. I didn't say it's, maybe hit the exact top. It could go still a smidge higher, but I do believe in taking some profits. Same story in Google, although that one I think may have a little bit more room to it, because Google I had drawn a channel into. The channel high is about, it's just below 800 actually. I don't know how long it would take to get there, but it's around 789 if it happened tomorrow. So it's possible that Google may have a little bit more room. If you're long Google, the hard stop for me would be 748, like 41-ish. You have tweezers there. That low, I think, would be the stop. So if you're long Google, that would be the absolute. If you start getting below 752.05, which was the gap high a day, and what did I say? It was 748.41. You probably want to play the GTFO. Facebook. That's another one. I think my record with Facebook has been explained, or is pretty well known. I mean, I've been bullish on the stock for a long time. Another one, we got the 1.618 Fibonacci extension, which was 109.28. We now have a few days of consolidation. If you look at the last time it ran on earnings on Google, which it did this time, a lot of the run-up happened on Google, not so much even on Facebook's numbers, although it did have that lift into it. There was a period of consolidation and chop sideways. That would be very healthy for Facebook here. It is not as crazy steep as Amazon is, but it's really run a lot. I mean, if you look from really where this rally started, it was in 86 and the stock got 110. There again, another one. There are periods of time where the stock goes through where it can languish a bit. I believe longer term Facebook will go much higher, but short term I'm a little bit cautious. That's all I'm saying. The options are super cheap in there right now. If you're long, if you're overly long and you haven't taken profits, probably take some profits and probably buy some protection. It's dirt cheap. You'll be very happy if the stock goes down. Apple. So someone talked to me about Apple the other day, and I said that the key for Apple, that it had looked really bullish to me, that it needed to hold though the 119.75, and then yesterday you had a downgrade, and also this new Tag Heuer watch came out, which I think smokes the Apple Watch. It might not do all those biometric things, but it's really nice. I mean, I might actually get one, maybe the second gen, maybe even we'll see. It looks really, really nice, and I think that it makes the Apple Watch look like a toy, frankly. So longer term, I mean, of course, Apple is going to do well with that, but I think that they're going to start facing a little bit of competition there. The real concern was the supply chain on iPhone. I don't necessarily believe that it's as weak as people are making it out to be, but this is what happens with Apple when it gets overbought on the stochastics. The big problem I see for Apple here, though, is that this leg, this sort of rally, has come up high enough that if it really fails here, it will be failing from a lower high that stalled at real resistance. And this could really signal a intermediate top for Apple. It really looks like it's starting to bow and roll over, and this was sort of the check back into it, and it's failing. I believe that if you're long Apple here, there are some major concerns below 119.75. If you want a still closer number, I know a lot of people are not going to want to throw in the towel so quickly. Let's play the 50-day moving average game. There is a gap fill from Apple on earnings at 114.55. Anything below there and anything below 115 to me gets risky. And it can put a move, even believe it or not, as low as 109 or 107 back on the table. That could happen in a minute. If Apple is going to truly be bullish, it needs to hold that 114 to 115 area. The 50-day is 114.32. So if you start losing that area, GTFO, or just play it short. Simple. Cross that one off the list. Cross Facebook off. Let's go into... I'm going to have to cut back on some of these because we just simply aren't going to have the time, and I want to end soon. So let's do just like 2 or 3 more. Baba. So last year, almost to the day, it failed. I think I covered SPY, didn't I? We could cover it again. I'll wrap on SPY. So Baba rallied. I mean, this is an amazing run, actually. It went from 57 and change up to 86 and change. Wow, that's pretty bullish. It broke the downtrend. It did, however, like I said, get into some major resistance areas. It has failed on one of the key supports, 82, 81, actually, I have written down. And the must-hold, in my opinion here, is the 77.77. It's a proprietary level I have on my chart. You could give it a little bit more leeway into like 76s. It's a very frustrating stock. That's really the level it needs to hold. The last gap fill was 76.35. So you're within, a couple of bucks of where it really should support. the upper distribution here of the volume profile really is here. It really needs to hold here. Last year, like I said, almost to the day, singles day, 11.11, for those of you not in the know, that it was the top in the stock, and it did nothing but go straight down. Will it do that this time? I don't know. And the fact that I don't know and you don't know means we all don't know, and that is very scary. I would be interested in playing put ratios in BABA as it comes down. The big gap fill and the 50% fib is in the 71-ish, and the 61.8 is around 68-ish. There's a 50 MA somewhere in there in the 69s. So I like put ratios as it comes down. If you're bullish on BABA and you want to play for, if you miss the run, you really think it's turned the corner, you want to own BABA, put ratios, good way to get long. You with the intention of maybe taking the stock and just getting in cheaper, or if you just want to play sort of the chicken hawk way short. Tesla. So Tesla gapped on earnings. That was my call that I thought it was long for earnings. It held for a couple of days, and now it kind of came back and filled most of the gap in. It didn't fill quite fully. It kind of just tested into the range and then ripped. It is still above the primary trend lines that it needs to hold, so it is still technically kind of bullish. It's in a wedge. It's getting sort of toward the lower end of the range. I'm sorry that it was actually bounced today. I was hoping for it to go a little bit lower to sell some puts into, but I believe that as it comes in, you could sort of sell some puts into those reference low areas. Anything kind of close to like 204, 205, that area I think is like where you want to sell like the lower puts, maybe like something in the 180s or the 190s. That's Tesla. I think probably a lot of the weakness in Tesla has been because of the weakness in oil and the weakness in solar. And, if gasoline's cheap, it's hard to justify an electric car. Kind of just is how it is. So USO, since we're talking about this, is really sort of bad. It's not looking great. It's sort of right around the lower end of its recent range. It's even a little bit below where it should have. I mean, if USO is really going to stay healthy, it really shouldn't have lost 14, 16-ish, and we're below there here now. That was really the sort of the range up. I have said for a while I am in the I guess the camp that oil is bottomed. It could retest the low. It's possible. If you want to talk about I like to really talk about CL. That's truly what I like to look at more than the USO. That is still closer to. It didn't break its last low. It is slightly below where it really should have held. Not as dramatic as USO is. But, it could retest 37. I've said that I think the absolute max would be 33. I don't know that that's going to happen. We'll see. The only way I would be playing oil is via the integrateds. I actually put on a put ratio today in Exxon. I think it was 78, 76, or what was it? Let me see. 78, 76. I think it's 16 DTE. I just did it really small. I don't usually like to do those more than the same week or the week after. I do think that, though, I want to get long Exxon back at 76. I had been long for a while. I got out a little bit early. It went a little bit further. My targets were 83 and 86. It got into the 87s, but it is well below there now, and it's in the 81s. So I guess it worked out. I would be looking to get long back where the sort of flag broke out from, and that was 76. And that's sort of how I'm playing it. Like, I want to be long there, so I'm playing it. I guess I'm playing it short, but with the intention to get long, if that makes sense. So Exxon or Chevron, I think, is the other one. The other one I'd sort of be looking to play. They have has a big dividend. Chevron has held up pretty well. My fingers are crossed that they bring this thing back down to 81. I would love to be a put seller there. I'd probably be looking to sell like 77 halves or like even 75s. There's a gap there. I don't know what the premium would be like, but something in those mid 70s, I think those puts would be ripe to sell. Okay, Twitter. So, jeez, this thing. It broke yesterday, 2 days ago. It broke the channel. The problem for Twitter is it's not Facebook, and Snapchat just lowered its valuation. I think that the problem with Twitter is that until they show MAU growth, all news is either irrelevant or neutral, and that's just how it is. It's a show me stock. It's probably going to just chop around down here, and you probably have better places to put your money, frankly, than Twitter. If you're a longer-term believer, you shouldn't be even worried about this conversation. My big fear with Twitter is that if and when the market rolls over, which it is, believe it or not, in some danger of doing right here, and I will end on that, this stock could be cut in half again, and maybe even worse, because it's still trading at a growth multiple and it has no growth. That's sorry. I love the product, but they're monetizing decently. I think their product is okay. It's really not prime time, I guess, for the masses. People are really using Instagram more, and they are not using Twitter. I think that they should do well with all these debates and stuff, but until they can show they have monthly active user growth, they are going to be either, it's just not going to do well. Netflix, this has just been kind of messy. It's doing okay. It's kind of chopping around at the upper part of the range. It's sort of the lower part of the range has been the 93s, and the upper part has been the 115s. As long as it holds, I guess, 110 kind of, 110.23, I guess you could kind of own it. It's weird. It's in a channel. It's sort of bumping up against the top here. You really need to see this thing take out 115, in my opinion, for still higher. I think that could be on deck if the market holds up well. I've really been looking, though. I have to say I've traded this well, but I have not been right on my sort of longer prognostication where I thought it would come back down to 70 and retest that big breakout. They're probably, with the way this market trades, probably 1 quarter away from, one miss away from that. But the stock is just chopping sideways. We know that they have been the winners. They're slamming the cable companies. I think the cable companies now are not even giving them Netflix as much advertising because they're so afraid that people are switching over. But Netflix has proven themselves. They're doing well. The Head & Shoulders at this point, I will say, is negated. It's come up too much. It's spent too much time up here. Now it's just sort of a question of if it's going to chop sideways and be a lower high and it's just kind of distributing up here, or if it's going to get the punch through. Why guess? It needs to clear 115. If it clears 115, the all-time highs are in play. If it can't hold 115 and it goes back down, you'll probably see the 103 to 105 range again, and then maybe even the 93s. I mean, who knows? It is above the downtrend, which is good, but it is just consolidating. To me, it looks like it probably wants to punch higher, assuming the market stays strong. If the market falls apart, Netflix is not going to probably hold up that well. All right, so I think we covered enough here. Let's end on I'm going to end on two quick things on the VIX and then also the SPY. So VIX is kind of forming a rounded bottom a little bit. It's looking to me like it might want to launch again. I wouldn't say that you're really in danger of a big market correction unless you clear the 17s. Once it clears the 17s, then we're going to see the 20s and then the 22s and 25s and all that nonsense. I shouldn't say nonsense, but those are the levels, the kind of the supports and the resistances. It is possible that we, just chop sideways here, but I would not be shorting volatility here. I would be more into buying than selling, if I had to choose. That is my opinion. You're still kind of below the longer-term downtrend line. You're also below the downtrend line from the recent spike. So there could be some room up to the 50-day, which is around the 19s, and it'd still kind of be no big thing. It would actually be healthy, but, VIX tends to trade in a range, and we're kind of in the middle of that sort of safe zone. Let's end on SPY. So SPY got kind of high, not to rhyme too much. The top of the market, believe it or not, was the 1.618 Fibonacci extension, which was sort of the death knell for Walmart, the death knell for Macy's, and maybe the death knell for the S&P. We'll see. We got up to the 211s. That 2100 in the ES has been like the really key level. My important level though wasn't 211, it was 210. That had been a big point of contention, so I sort of believe that if you're on the upper side, the right side of 210, the all-time highs are in play. If you're on the lower side of it, it's a little bit more risky. Today, like I said, just felt heavier than the internals. Just experience felt a little bit heavier than the internals might have implied. I think if tomorrow isn't an up day, and I know this is going to sound, kind of like duh, but if it isn't an up day, I think we could be down big tomorrow. If it is an up day, just forget that for now. We still would need to take out 207. There's a 200-day moving average around 206.47. There's a big gap fill sort of at the lower end of our range, which is 205.38. I think that could fill. It wouldn't even be that bearish if it just kind of came down. It would be really healthy. The market ran a lot. Believe it or not, if you use the 186.93 sort of launch point, which was the check back low and then rally, a 50% fib would still take you to 199, like right around that 199 area, and the 50-day is down around 200. So you could probably still come back there and not, be in complete panic mode, although I would be in panic mode if we lost the 204s. Sorry, but that's really a key area. I have been, let's keep it really simple here. I'm going to make it even simpler for you guys. The Fed day range. That was, the high of the day there was 208.98. The low of the day was 206.21. We know that the 200 is right around there, so let's use that range. Anything above there is bullish again. Anything below there is more bearish. Real simple. Keep it simple, stupid, right? That KISS. The old saying. So I'm going to repeat that level again, 208.98. Anything above there, more bullish. I believe today's high of day stalled just below there. So that is the correct level. Anything below the 206.21, I think we're going to be in for some more correction. So I'll end it on that. Anyhow, if you're not following me, follow me on Twitter. It's @JustinPulitzer. If you came in late to this or you want to watch any part of this again, I think there's and you'll be able to fast forward if you want. It's going to be on YouTube. That's Justin Pulitzer Trades. Be sure to subscribe to that channel. You'll get notifications when I put up Periscope rebroadcasts, weekend video reviews, or special edition videos. I hope you guys found this video helpful. My next video will be up on Sunday. That will be the weekend review video. And I'll have had the benefit of seeing the next 2 trading days. Tomorrow, just a quick warning, there are like 6 Fed heads talking, including Janet Yellen. Tomorrow could be really all over the place. Whippy Lacker is speaking. He's been the main dissenter. He's been so wrong. I don't even know how this guy can, be. He should be working at Chuck E. Cheese, not at the Fed. No offense to Chuck E. Cheese. You have Dudley, who's important. That's the New York Fed. You have Yellen, and then someone just said Draghi overnight. Tomorrow could be really, really whippy. I'm sort of probably going to wait until the end of the day to sort of do more trading once these people are, I'm being kind, these human beings are done speaking. I could say morons or idiots, but we're, trying to be more of a statesman. What the Fed really needs to do is just STFU, shut the F up. Anyway, they aren't going to, they aren't going to shut up. They're going to be speaking tomorrow. Just be really careful tomorrow. That's going to be real whippy. There's some, I think the JOLTS numbers, some jobs numbers are early in the morning. So this could be, if that's a hot number, a good number, which I'm sure the media will figure out how to color good. We could be in for a rocky road. Okay, that's all. Hasta la vista, baby.